dive. Today, we're getting into something pretty big, building wealth when you're starting with, well, nothing.
Yeah, zero. And we're using Mark Tilbury's YouTube video, How to Build Wealth with $0 the Easy Way, as our sort of guide.
Now, I get it. Easy wealth sounds maybe a bit too good to be true, right? There's definitely some skepticism potential there.
For sure. But our goal here isn't just to take his word for it. It's to really dig in.
Exactly. We want to pull out the practical stuff, the mindset shifts, the key moments he talks about, not just generic advice.
And Tilbury shares a lot of personal stories, which is interesting. It's not just theory. It's grounded in his own, lived experience.
Okay, let's jump right into the mindset piece. He tells this story from school. You know the one.
Oh, yeah, the dream job, dream car thing.
Right. He puts down business owner, Ferrari, mansion. Pretty ambitious stuff for a kid.
And the teacher's reaction was basically, maybe aim a little lower, be more realistic.
Yeah, a bit of a polite shutdown. But what's key is how Tilbury reacted internally.
He didn't buy it. He sort of held on to those high expectations, didn't he? It sounds like that refusal to lower the bar was pretty fundamental for him.
Totally. It taps into that whole growth mindset idea, believing it's possible in the first place.
He actually says, if you can't even picture it, how are you ever going to put in the effort? Which makes a lot of sense.
And he brings up a really good point about who you listen to. It's not always the obvious hype guys online.
Sometimes it's people close to you, right? Well-meaning friends, family.
Yeah.
But maybe they haven't built wealth themselves, so their advice comes from a different place.
Exactly. They might unintentionally project their own limits onto your dreams.
So maybe something for you listening to think about is, are there voices around you, even subtly, kind of nudging you away from bigger financial goals?
Tilbury implies you might need to, identify those influences and maybe create a bit of distance, a necessary step sometimes.
Okay, so from belief to action. He talks a lot about problem solving.
Right. He noticed people often give up too easily. First sign of trouble, and they're out. Which just reinforces that feeling of, I can't do this.
His strategy is pretty specific. He forces himself, when stuck, to brainstorm at least 10 different solutions. 10.
That's a high bar, but it forces creativity, doesn't it?
It really does. It shifts you from just hitting a wall to actively looking for doors, windows, maybe even digging a tunnel.
It's about becoming resourceful instead of just accepting the obstacle.
Think about times maybe you've hit a roadblock, career, finances, whatever.
Right.
Was the first instinct game over, or did you start thinking laterally?
Aiming for 10 solutions forces that lateral thinking. Okay, the obvious way didn't work. What else is there?
And that naturally leads into his next point, getting uncomfortable. Stepping outside the comfort zone.
He uses that Harry Potter analogy. Staying in the cupboard under the stairs means you never face Voldemort. You have to leave the familiar.
And he shares his own story, the bullied carpenter's apprentice.
Yeah, quitting that job sounded scary, like giving up stability.
But he framed it differently. He was young, felt he had, quote, nothing to lose. So he took the leap.
He saw it as a calculated risk, given where he was in life. Fewer responsibilities, maybe?
Which connects to a broader point, especially if you're earlier in your career. Taking calculated risks when you have less tying you down, that can be smart.
There's even research, isn't there, about job hopping potentially leading to faster salary increases compared to staying put.
Yeah, sometimes staying in the safe job is actually the riskier move long term if it means stagnation.
And if you do stick with traditional employment, he suggests focusing on roles where your pay is tied more to results, not just hours worked.
Getting away from just trading time for money, finding ways to scale your impact and therefore your income.
Okay, let's shift gears a bit. A big turning point for him seems to be investing.
Definitely. He had his model shop going, things were okay, but he wasn't really focused on making his money grow for him yet.
Until that work experience kid, right? The story is pretty memorable.
Yeah, this young lad confidently invests, £1,000 in a stock?
And the stock just skyrockets, like 10x in 2 weeks or something crazy.
Which obviously made Tilbury go, whoa, hang on a minute. It really opened his eyes.
It hammers home that sooner rather than later thing with investing. Don't wait.
He even throws in some stats, I think, from Fidelity about the cost of missing the market's best days.
Yeah, missing just the top 5 best days over decades could cut your gains by 38%. Miss the top 10 and it's over 55% less potential gain.
Which is huge. It basically shows you can't really time the market effectively. Trying to jump in and out, it's likely a losing game for most of us.
The real takeaway is just being in the market consistently. Time in the market, not timing the market.
But importantly, even after that initial lucky break he witnessed, he doesn't advocate just gambling.
No, absolutely not. He really emphasizes doing your research, understanding what you're actually putting your money into, long-term perspective.
And he gets practical, too, about choosing an investment platform, what features to look for.
He mentions user-friendly charts being important. Makes sense, especially for beginners. Visualizing helps.
Being able to see trends, performance, it makes it less abstract, more accessible.
He also talks about needing a good range of stocks and ETFs, exchange-traded funds for diversification. We'll circle back to that.
And paper trading, that's simulating trades with fake money, right?
Yeah, basically practicing without risking real cash. Good for learning the ropes.
But he adds a warning, doesn't he? You have to treat it seriously.
Right. If you just mess around because it's not real money, you don't really learn the decision-making process under pressure. He mentions Web as a platform offering these tools, by the way.
It's a good point. Paper trading teaches mechanics, helps test strategies, but it misses the emotional kick of having your own money on the line. It's practice, not the real deal entirely.
Now, staying with risk, he tells a pretty sobering story about a friend who was seriously wealthy.
Yeah, on the UK rich list, apparently, and lost it all.
How did that happen? Something about leverage.
Exactly. A leveraged investment group he was part of collapsed. The big lesson Tilbury took? Never invest in something you don't understand.
That feels incredibly important, especially now with so many complex options out there.
The lure of high returns is strong, but if you don't grasp the how and the what could go wrong, you're flying blind. Leverage basically means using borrowed money. Magnifies gains, but also magnifies losses, sometimes catastrophically.
Which leads straight into diversification, the classic advice.
Don't put all your eggs in one basket. Simple, but fundamental. For his own stock investments, he mentions using a 3-fund portfolio.
What does that involve again?
Typically, it's a total U.S. stock market index fund, a total international stock market index fund, and a total bond market index fund, spreading the risk across different markets and asset types.
It's about balance, trying to smooth out the ride. Less volatility.
Exactly. Different asset classes often react differently to market conditions, so combining them helps reduce overall portfolio risk, aiming for steadier growth.
But he doesn't just diversify within the stock market, right? He goes broader.
Yeah, he mentions other assets too. Real estate, classic cars, even high-end watches. It's about not being too dependent on any single investment type's performance.
And then he takes that same diversification idea and applies it to income, which is fascinating.
It really is. It's not just about investing money from one job. It's about having money come in from multiple places.
He lists quite a few for himself. Physical shops, a distribution company,
Affiliate income, ad revenue from content, dividends from stocks, rental income from property.
Wow, okay, so lots of different streams.
And the point is resilience. If one stream dries up or takes a hit, say a shop has a bad year, or ad rates dip, the others can cushion the blow. You're not wiped out by one failure.
That makes so much sense. Building wealth isn't just about returns, it's about building a stable foundation.
Right.
Multiple income streams seem key to that.
Absolutely. It reduces vulnerability, gives you more options, and frankly, probably accelerates the whole wealth-building process.
So wrapping up this deep dive into Mark Tilbury's ideas on building wealth from zero, a few big themes stand out.
Definitely the mindset shift first. Believing it's possible, pushing past limits, dealing with negativity.
Then that proactive problem solving, not giving up, forcing yourself to find alternatives.
Taking calculated risks, especially early on. Getting out of the comfort zone.
Investing early is huge in his narrative, and doing it wisely, diversification, understanding what you own, avoiding dangerous leverage.
And finally, applying that diversification idea not just to investments, but to income itself. Building multiple streams.
And just to reiterate, these are the takeaways and stories directly from his experience as shared in that video.
Yeah, his perspective on his own journey.
Which leaves us with a final thought for you listening. What's maybe one belief you hold about building wealth, maybe a limiting one that you could start to question or challenge?
And following from that, what's one small, manageable step you could take? Maybe even today. Could be exploring a side hustle idea or just starting to learn the basics of investing. Something to nudge you forward.